morning. Thank you all for joining us today to talk about our proposed climate disclosure rules, National Instrument 51107. I'd like to introduce a couple of my colleagues. So Craig Burns and Michelle Turner are both in the ASC's energy group, and Amanda Kusinoras is in the corporate finance group. Amanda will be watching for questions as we go through the presentation, and we'd like to encourage you to ask those questions. There may be time at the end for other questions, but I think it's helpful if you just ask it as we go along. Now, if you have a very specific question or a very technical question, or we simply run out of time, we'll follow up with you. So please, don't hesitate to email us or put the question in the chat, and if we don't get to it, we'll circle back with you. My name is Tanya Fleming. I'm a lawyer in the corporate finance group, and I'm a member of the team of people representing the securities regulators across Canada who's been working on the proposed rules for climate-related disclosure. I live and work in Calgary, Alberta, which is in the Treaty 7 region of Southern Alberta. And the Alberta Securities Commission serves investors and capital market participants throughout the province of Alberta, which includes people living in Treaty 4, 6, 7, 8, and 10 territory. We're grateful for the ancestors who have been caretakers of the land for generations, and I am thankful for the many blessings given by the land we share, including white snow in the winter and blue sky all winter long. So disclaimer, of course, that the views expressed here are those of the presenters. And another important disclaimer is that this is we're talking about a proposed rule. So we are not in the final stages of this rule. This rule has been published for comment, and we are looking to hear from market participants. So what we're talking about today is proposed, and when it appears again in final form, it may look a little bit different than you see today. So a bit of a roadmap of what our presentation will look like. So before we talk too much about the proposed rule, I'd like to set the stage by talking about some of the international initiatives around climate-related disclosure. My colleague Craig will provide some information on greenhouse gas emissions, and we'll look at the current disclosure requirements and an overview of the disclosure reviews that we did earlier this year. We'll then turn and look at the key elements of our proposed requirements. The Alberta Securities Commission's mandate is to protect investors and to foster a fair and efficient capital market. We try to be a practical, intelligent regulator, and we work hard at striving the right balance in our approach to new law. We know that investors are increasingly focused on climate-related risks, and we see that companies are responding to those investor requests. That's currently being done largely by way of voluntary reports, so outside of the securities regulatory regime. And we know in Alberta, our companies have just been leaders in terms of climate disclosure. We have many companies in Alberta that have been publishing ESG, sustainability, or even standalone climate reports for years. So really, Alberta companies have been working very hard and leading the way here. The work on our proposed requirements is actually co-led by the Alberta Securities Commission and the Ontario Securities Commission. But every single securities jurisdiction in Canada has been at the table. Coming out with a harmonized rule was really important to us. Just practically, most of our Alberta companies will be subject to securities laws in other jurisdictions as well. So it's, of course, efficient to have a harmonized law across the country. And this is, of course, especially important to Alberta companies because we are a capital market that has deep expertise in energy and also in energy transition. We want to get this right. We want to hit the mark. We want to respond to investor needs and align with international standards. We're also cognizant of regulatory burden and the additional costs that our companies will bear in responding to new climate-related disclosure rules. And you have to remember, Alberta companies come in all shapes and sizes. Our largest issuers are leading the way when it comes to climate disclosure, but some of our smaller issuers just haven't started this journey yet. And it's not that they don't think it's important, but there's a lot of things to be done when you're a small issuer. You have limited resources, and resource constraints are very real. We've published this proposed rule. We published it on October 18th. We're in a consultation period currently. And of course, as I already mentioned, this is the proposed rule. It will likely change slightly before it is published in final form. It's important that we hear from you. So you can help to shape what the final version of this rule looks like. It's best if you send your comments in writing. If you look in the staff notice that was published, there's instructions of how to submit comment letters, and there's also a section at the very end that's just called Request for Comments, and it has a number of questions to help elicit some of the information that we're hoping to get from the market. So those comments are due January 17th. So, you know, we're into holiday season now, so enjoy the holiday Zoom party and take a break. And then when you come back in January, please take the time to read through the proposed rules carefully, think about how they will impact your company, and send us a comment letter. So put it in your calendar for when you get back, so that you don't forget.
Tanya, I've received a question. What does the CSA do with comments that are sent in?
So all of the comment letters that will be sent in, they're all published. So comment letters are public. And the CSA will go through all of those comment letters. We'll look at kind of themes that are coming out of them, what issuers are telling us about what we got right, what we didn't get right in the proposed rule. And this will be part of that iterative process that will happen between the time the comment period closes and the rule is published in its final form. So they're important. They're taken, comments are taken into account when we're looking at how we finalize this rule. So if you go to the next slide, virtually all of the companies that are publicly listed on Canadian stock exchanges will be subject to this proposed requirement. And that's really important because I think initially, a lot of people thought that this applied to the oil and gas sector or the extractive industries, and that's not the case. So this proposed rule will apply to publicly listed companies in all sectors across Canada. If you're listed on a stock exchange, whether the TSX exchange or the venture exchange, this will apply to you. So there is some transition that's built in, because of course, you know, their venture companies will be smaller. There's some time additional time that's given for them to prepare. So we're looking at a 1 and 3 year period. So 1 year for our non-venture issuers and 3 years for the venture issuers. So it's January 1st. Of the first or third year after the rule comes into effect. So if, for example, the rule came into effect on December 31st, 2022, and this is a company with a December 31st year end, then for a TSX listed company, it would apply to the financial year beginning January 1st, 2023, ending December 1st, 2023. And then it would appear, the disclosure would actually make its way into the filings that are filed in March of 2024. And similar timeline, but out a bit for our venture companies. So particularly when we're talking about greenhouse gas emissions, which Craig is going to touch on in this presentation. So to the extent the rule comes into force on December 31st, 2022, companies would need to be in a position to collect that data for the full 2020 year. So you'd have to have your data collection systems and your internal controls around the collection of that information in place by January 1st, 2023. So for companies that haven't yet set up their systems or their internal controls, it may be helpful to use the time while this rule is not yet final, so we're still in consultation or the rule is being finalized, but to give some time to in fact get those systems in place before the rule comes into force. So an important, I'm going to talk about TCFD because it's we reference it throughout the presentation, and I want to be sure that everyone is familiar with it. So in 2015, the International Financial Stability Board established a task force, and that task force was to develop recommendations for more effective climate-related disclosure. So Task Force for Climate-Related Disclosure, TCFD. 2017, they released their recommendations, and that provides the framework for climate-related disclosure. This framework is it's very comprehensive, and it's very, very well supported. So in 2021, TCFD published a status report indicating that they had over 2,600 supporting organizations globally, including 1,600 financial institutions and $194 trillion in assets. It's TCFD has become a framework that is very, very widely used globally. So the CSA is one of the first securities regulators in the world to publish climate-related disclosure rules for comment. The UK has already come out with their climate-related disclosure rules for their premium listed companies. So they're very large companies that the rule came into force for accounting periods beginning on or after January 1st, 2021. And so those companies are collecting this information, preparing to disclose, and we'll see those disclosures made in the spring of 2022 for those large UK companies. The UK is consulting on a proposal to extend those requirements to their standard listed companies, but currently their premium listed companies are currently they will be including TCFD associated filings in this coming spring. In the US, the Securities and Exchange Commission has indicated that climate-related disclosure is a priority. You know, we saw that shift when Biden took office. It was on his first day that the US rejoined the Paris Accord. SEC has said climate is a priority for them. They had originally said that they anticipated publishing their climate-related disclosure rules this year, but before the end of this year. But I just read a couple of days ago that SEC chairman said that they'll be published in early 2022, and he did make the comment that they will be aligned with the TCFD framework. So we're watching very closely what the US does, because of course we have tremendous integration of our capital markets. Very, very interested to see what they come out with. The EU has a corporate sustainability reporting directive that they've said will be adopted in October of 2022. They've indicated that will be TCFD compatible. They have already in force as of March of 2021 Sustainable Finance Disclosure Rule, which requires sustainability disclosure in investment products. So that's currently in force. And we know that Australia, New Zealand, and Switzerland have either in their current rules or their proposed rules, they are TCFD aligned. So we've really seen the TCFD framework take hold as the framework that we're seeing internationally people are looking to align their disclosure with. So another international initiative is IFRS, which is the International Financial Reporting Standards Foundation. They announced a new International Sustainability Standards Board. So that was announced during the United Nations Climate Change Conference, COP26, in early November of 2021. So this International Sustainability Standards Board will exist alongside the IFRS International Accounting Standards Board. There's two offices, one in Frankfurt, Germany, the other in Montreal, Quebec. And they have said that their first initiative will be climate-related disclosures and that will align with TCFD. So it was in November 3rd, the IFRS published a prototype of their disclosure of sustainability-related financial information. So that was, of course, after we published our rule, our proposed rule, October of 2021. We knew that there was going to be lots happening in the time that our rule was out for comment. We thought, so we've seen this, we've seen the IFRS publication of their prototype for disclosure standards. And of course, we're waiting to see what the US comes out with. So lots happening right now, like it's just evolving in real time.
Tanya, there's a question. Has the CSA looked at whether its proposed rules are consistent with the IFRS prototype that's now been published?
Yes, I mean, we've certainly, so we published first, and then this came out on November 3rd. We've gone through it, and we would say it's our proposed rules are not incompatible. The IFRS ISSB prototype, it's far more detailed. Our rules are, kind of set up this framework for disclosure. Here are the types of things that will set the key areas of disclosure. But the IFRS prototype document, which of course it's still a fairly early draft, so there's lots of time to come before that comes into force. It's a lot more detailed. And I know if I was the one who was drafting this disclosure, preparing the disclosure, I would reference, I'm interested in looking at this because it gives me some really good information on what types of things I should disclose in order to meet the framework. The accountants and the accountants particularly will like having that additional specificity, I think. I'm going to turn it over to Craig now to talk about greenhouse gas emissions.
Good morning, everybody. Very happy to be here today. So I manage the energy group at the ASC. We were recently, or until recently, known as the petroleum group. I'm not sure if anybody here on this has had the opportunity to communicate with us in the past, but just want to let everybody know that we are here dealing with energy issues. We have an all things energy focus. We're also joined here today by Michelle Turner, who is an evaluation engineer within the group. And we're very approachable. I know that was mentioned earlier. We consider ourselves very willing and able to help you on anything related to energy. And it just so happens that emissions fall into our bailiwick. So we're here today to talk a little bit about greenhouse gas emissions, as Tanya has mentioned. So one of the things we're doing, and we've been doing over the last few years, is really trying to get a handle on what people are doing with respect to emissions disclosure. We started doing this much more aggressively within the last year as this process, the CSA process, has picked up steam. We're really just trying to figure out what people have been putting out, how they've been putting it out, the reporting standard used, where the disclosure is occurring, the frequency of disclosure, et cetera, et cetera. That's, we've learned a lot from doing that, and hopefully that information is going to help us as we move through this CSA process and start seeing actually, as we move into more of the required disclosure, as opposed to just the voluntary. And one of the things that's really important is to understand the scope of emissions when we're talking about GHG emissions. So we'll just quickly go through this here. So when we talk about scope 1, we're talking about the direct emissions that are directly controlled by a company. So let's think of it here. If you're operating a factory and you're burning fuel in the manufacturing of a certain product, so that would be caught under scope 1. And we talk about scope 2. We're talking about indirect emissions. So if you're purchasing electricity to help you manufacture a product, that would be captured under scope 2. We get to scope 3, that's all the other emissions, that's upstream and downstream. If there's any doubt about where the emissions fall, it's likely, or within your value chain, it's likely within scope 3. Think of scope 3 as outsourcing of production, contractors, employee travel, things like that. Those would be considered scope 3. Let's move on to the next slide, please. This graphic right here hopefully gives you a little bit of an idea. This is actually taken from the Greenhouse Gas Protocol, which the proposed instrument points to for the preparation of the disclosure. And this gives you hopefully a little bit of an understanding of the 3 scopes that we've just talked about here. In that cloud, you'll see the different molecules up there, CO2 being the one that everybody seems to know about. There's other ones as well that are caught under greenhouse gas emissions. One of those, another important one being methane, there's nitrous oxide, but hopefully this graphic gives you a little bit of information. I would just strongly suggest anybody that wants to know more about the Greenhouse Gas Protocol to go, actually just Google it, and you go right to the website. There's courses, there's a lot of information on the website that help get up to speed on what this is all about. And my expectation here is that you'll find what you need on there, but if not, please contact us. We'll help you out in any way we can. Thank you.
So if we look at what's happening currently, so the CSA has published guidance to help companies understand disclosure requirements relating to climate and climate matters. For a long time now. So 2010, the CSA put out their first guidance around environmental reporting. We had a staff notice in 18, and then in 19, again, guidance on disclosure of climate-related matters. We're looking now at transitioning from guidance to law. So this would be requirements that are applicable to listed companies. And again, in the consultation period, and it's just so important that we hear from you. So as you're listening today, or you're reading the proposed rule, please think about how this rule will apply to you, and please don't hesitate to send us in your thoughts. So when we first started this process, we wanted to take the time and to look at what issuers are doing currently. So in terms of a disclosure review, 47 issuers were selected, and these are large issuers. So these were companies that are on the S&P TSX Composite Index, and market caps ranging from 800 million to 180 billion. So these are large companies, and just through wide range of industries were included in the review. So this was not an oil and gas focused review. It was issuers from across Canada, large issuers. So to see where those issuers are at with their climate related disclosure. And as part of that review, we looked at information that's in the security law filings, so continuous disclosure filings, as well as voluntary reports. So in the continuous disclosure filings, looking at how companies are disclosing information with reference to that guidance that had been previously published, and specifically looking at risk disclosure. And then in the voluntary reports, keeping our eye open for what could potentially be material climate-related information that really should have been in regulatory filings. And also just for information, looking at what frameworks people are using to disclose climate-related information, and what is the frequency of GHG emission metrics being disclosed. So over time, I mean, just tremendous improvement. As you know, I mean, investors are asking now about climate-related information, and companies are, of course, responding to those requests. So, you know, from the last review, I think that was done in 2017 to 2021. I mean, there's just a tremendous difference in the quality and quantity of climate-related disclosures that are made. The statistics I have below, now keep in mind, this is of the group of issuers that were reviewed. So these are the large issuers. But of that group, we saw like almost everybody is including climate-related risks in their regulatory filings. But less than half had information about their board oversight processes and how climate considerations relate to the company's strategy. Again, voluntary reports, you know, most of these issuers were publishing climate-related information in a sustainability or ESG report, and many had been publishing ESG reports for years and years. We saw, you know, a large percentage that had disclosure of GHG emissions, with almost 40% disclosing scope 1, 2, and 3 GHG emissions. More than half disclosing scope 1 and 2 GHG emissions, and then a small percentage that was just disclosing scope 1. We saw lots of frameworks being used here. So again, most everyone was using at least one third-party framework, but we saw about half of those issuers reviewed were actually referencing 3 third-party frameworks in their disclosure. And there was selective reporting against frameworks, and that's not surprising. This is voluntary disclosure. So companies were picking aspects of each of those disclosure frameworks, perhaps finding things that they thought best fit with their company, but no, you know, just disclosing selectively along the various frameworks. One thing I'll say that we've heard in the consultations that we've done with some of our smaller companies is they're pretty happy now to be pointed toward a particular disclosure framework, especially for a company that has limited resources. You know, there's so many frameworks out there. There's kind of 3 primary frameworks, but there's lots of different climate disclosure frameworks, and it's tough for a small issuer to invest the time in getting their staff up to speed on you know, multiple frameworks, and maybe investing a lot of time in one, and then later finding out, oh, actually securities regulators want you to use TCFD instead. So smaller issuers have told us that they're happy to be pointed in the right direction and say, okay, TCFD framework is the framework that we'd like you to use, and then they'll apply the resources there. So we'll look at the proposed requirements in this disclosure rule. So there's 4 core elements: governance, risk management, strategy, metrics, and targets, and then GHG emissions. Of course, we'll talk about more. Some of this is required disclosure. So when it is required disclosure, there's no materiality assessment. It is simply required in your filings. You have to have it. Other aspects of the disclosure, there is a materiality threshold that you would first make an assessment. Is this information material? And if so, then you'd include it in your disclosure. So materiality, I mean, it's like just a cornerstone of securities law disclosure. So unless something is specifically required, you do a materiality assessment to determine whether this information needs to go into your regulatory filings. And information is material if a reasonable investor's decision to buy, sell, or hold securities would be influenced or changed if that information was omitted or misstated. So issuers get the first cut at this. You do a materiality assessment. Unless it's specifically required, do a materiality assessment. And if you determine that it's material, then you would include that information in your filings. So governance and risk management disclosure is required information in these filings. So all of the issuers all of the companies who'll be subject to this disclosure rule, which again is like virtually all companies. If you're listed on a stock exchange in Canada, you'll be subject to it. Governance, risk management, this is narrative disclosure, but it will take work to pull it all together in order to put it into your filings. So on the governance side, you'll have to spend some time thinking about, do your directors have the right skills? Are they competent and have a good understanding of climate-related disclosures? If you publish a skills matrix for your directors, you may want to add information about climate into that skills matrix. There's always information provided about director education initiatives, and this may be an area where it would be helpful for the company to spend some time with directors in terms of bringing people up to speed on climate-related disclosures. And then just in terms of where the oversight rests, will the board, will oversight for climate-related disclosures be at the board level, or is it at a specific committee, or maybe it's in multiple of the board committees? So, we often see companies have an HSE committee, health, safety, and environment. That may be the place to have primary oversight of climate-related risks, or some companies are just simply integrating it into the mandates of all of their committees. On the risk side of things, describe the company's processes for identifying, assessing, and managing climate-related risks. Companies may have an ERM program, an enterprise risk management program, with a risk register. Are climate-related risks on that risk register now? If not, they'll need to be added. There'll need to be some thought applied to identification of climate-related risks, and then how those risks are managed. So all of this, it will take time. It's narrative disclosure, but it will take time to get ready for it. And then strategy and metrics and targets. So this is where a materiality threshold is applied. So the company would first make an assessment of whether this information is material. And if it is, then this disclosure would be included. So describing company risks and opportunities over the short, medium, and long term, and the impact of those risks on the company's business and strategy. And metrics and targets, GHG emissions, maybe water consumption, land use, waste management, carbon footprint. A number of companies have made net zero commitments, so net zero by 2030 or 2050, or we've seen commitments to cut GHG emissions in half from some established base year by some certain year. Investors will be interested in performance against those targets. So if you've made a net zero commitment, then how are you tracking your progress toward that? Is net zero achievable? I mean, investors, they want to know more than just the fact that your company has set a net zero target. They want to see how you're moving toward meeting that target.
Tanya, in terms of the strategy pillar, there's a question: how has CSA defined short, medium, and long-term risk?
So, I don't think that short, medium, and long-term is in fact defined per se. I think that you would have to consider it as, relevant to the company, to the business. But I can tell you that I've seen in disclosure of oil and gas companies, I've seen short-term risks identified as being 1 to 5 years, medium being 6 to 10, and long-term being 11 years plus. But I don't believe there's actually a definition of what short, long, medium, and long-term is. So on this slide, this is the GHG emissions information. So GHG emissions there's 2 alternatives being considered here. And the second alternative actually has a couple nuances to it. So GHG emissions must be disclosed, but on a comply or explain basis. So what that means is that the rule will say disclose scope 1, 2, and 3 emissions and the required risks, or the issuer's reasons for not disclosing this information. And to the extent that you're taking the explain option, you can do that with reference to all 3 buckets, 2 buckets, or 1 bucket. So you can, say for an issuer who is disclosing scope 1 and 2 emissions, but they're not disclosing scope 3, they'll provide the information for scope 1 and 2, and then they'll provide an explanation of why they haven't, in fact, disclosed their scope 3 emissions. The second alternative that's being consulted on is disclose scope 1 GHG emissions, and this is where the nuance comes in. When material, so the issuer has made an assessment of materiality. So if that information is material, scope 1 emissions must be disclosed. Or B, in all cases. So in all cases, no assessment of materiality, simply mandatory disclosure of scope 1 emissions. In this alternative, scopes 2 and 3 GHG emissions would still remain in that comply or explain framework. And this is just a summary of, just a lot of words on a page, but just so you can kind of see at a glance. So governance disclosure and risk management disclosure is mandatory. That is going to be in the filings of every single issuer that's subject to this rule. Strategy and metrics and targets information will have a materiality assessment applied to it. And then GHG emissions will be disclosed on a comply or explain basis, or potentially with scope 1 emissions being mandatory and scope 2 and 3 on back to the comply or explain basis. So the issuer would need to include either the quantitative information on GHG emissions or provide an explanation of why they haven't disclosed that information. So, and where you'd see this information, governance information is proposed to be included in the management information circular or the proxy circular. So this is the document that goes out to shareholders in connection with a meeting in which directors are being elected. And that's where you see a lot of the other requirements for governance disclosure. So it made sense that governance information associated with climate would also be found there. If the issuer is not sending out a management information circular, then it would actually go into an AIF if the company prepares an AIF, or alternatively into an annual MD&A. And then the other buckets of information or disclosure here: strategy, risk management, metrics, and targets. That information would be found in the annual information form. And if there's no annual information form filed, then in the annual MD&A.
Tanya, there's another question. Since this information is going into the core documents, is the CSA expecting any of the information to be audited?
Yeah, we talked about audit when we were preparing the rule. So the answer is no. This information is not required by the proposed rule to be audited or to have an assurance process by a third party. But we do know that a lot of companies use the services of a third party to help them and to provide that assurance that the data is being gathered properly, that there are proper internal controls in place, and to give both directors and officers the comfort that that's set up properly, the information is good, is sound, and is appropriate for disclosure. I know, what do you think about this? If a company is raising money, so you're raising money, and you're doing that by way of a prospectus, then these disclosure documents are incorporated by reference into the prospectus and then become part of that standard that is associated with prospectus disclosure, which is full, plain, and true disclosure. It may happen that underwriters are looking for the information that is part of the prospectus to have an assurance associated with it, but that's not required by the rule in its current form. And that's something that is actually something, again, that we'd be interested in your feedback on.
Thanks, Tanya. And one more question. Why is the CSA not mandating scope 1 and 2 disclosure when the majority of issuers in our disclosure review did report on scope 2, and also the TCFD requires disclosure of scope 1 and 2?
Yeah, that's right. So this goes back to my comment that Alberta issuers come in all shapes and sizes, and that disclosure review that we did, that was really focused on the large issuers. And we see the large issuers as absolute leaders when it comes to climate disclosure. Those companies are putting out scope 1, 2, and 3 emissions, or at least scope 1 and 2 very, very commonly. But Alberta has a lot of companies that are smaller, companies that are listed on the venture exchange, or companies that are on the TSX exchange, but they're a small issuer. And many of those companies are not there. They're not there yet. A number of companies will be starting to gather GHG emissions. I think probably in 2022 as they start to prepare for these new rules, but they're just not there. So when we were thinking about what is how do we introduce this to our market, taking into account responding to investor requests for information, but also the regulatory burden on our small issuers, we made the decision to put ask for scope 1, 2, and 3 GHG emissions disclosure on a comply or explain basis, or alternatively focus on scope 1 emissions with 2 and 3 remaining comply or explain. We did have some modifications from the TCFD recommendations, and that's one of them that was hit on in that question. So TCFD requires disclosure of scope 1 and 2, and if appropriate, scope 3, whereas we've proposed comply or explain for all 3 frameworks. TCFD also requires scenario analysis, so it's a modeling exercise to look at how the company's strategy is resilient in different scenarios. Again, that was one of the things that we looked at, and we know that, again, our large issuers are doing this and are comfortable doing it. But at this point, we thought, there's so many companies that are really just starting out with climate-related disclosures, and we did not include scenario analysis in our proposed rule. I'm cognizant of the time, and I want to be sure that we do have time for additional questions. So maybe if Amanda, if there are other more general questions, or if people have questions, this would be a great time to hit those.
Sure. So another question: if the TCFD framework changes and evolves over time, does the CSA required disclosure automatically change with those changes to the TCFD framework?
Okay. So the CSA rule, we say our rule is aligned with TCFD, but what we don't do is just say you must comply with TCFD. So TCFD framework may very well change over time, but this CSA rule stands alone. So our rule has specific requirements, and it will say, and it's the sort of things that you've seen in the slide presentation, where it will have a very specific language: disclose this, tell us about this, describe this. If you are complying with TCFD, you'll also be complying with our rule, but you don't have to be constantly assessing changes to TCFD in order to be compliant with this Canadian rule.
And there were a couple questions on whether these slides would be made available to attendees.
Yeah, actually, we're going to put the slides on the ASC website, so that'll be available probably later today. These slides will be available. Good. Well, thank you very much. If there's no other questions here, we'll wrap up. Again, to the extent that you have specific questions or technical questions, don't hesitate to follow up. The slide here has an email address, energy@asc.ca. If you want to send your questions through there, then they'll make their way to Craig, Michelle, Amanda, or me, and we'll do our best to get back to you. So thank you very much for attending, and we'd love to hear from you again. Comments are really important as we work toward finalizing this rule. So please look at the staff notice that's published in accordance with the proposed rule. You'll see the address to send comments to, and as well, there's a section called Request for Comments that has a number of questions that we would specifically like to hear from you on. Thank you very much. Have a great day, everybody.